Today, we are pulling back the curtain on one of the most powerful and, frankly, most secretive strategies in all of high finance. It's called the basis trade. This thing is an absolute engine, churning out billions of dollars in profits for the biggest players on Wall Street. And the real secret? A lot of them consider it to be almost entirely risk-free.
So how is that even possible? I mean, think about it. How can one single strategy be so consistently profitable that it's behind trillions of dollars in trading every single day? That sounds less like a trading strategy and a lot more like a perfect money-making machine. Well, to understand the machine, first, we got to understand the principle it's built on.
And it all comes down to a concept called arbitrage. Now, this isn't about gambling on whether the market's going to go up or down. Nope. Instead, it's like being a detective, hunting for tiny temporary glitches in the market, these small price differences between two assets that should, for all intents and purposes, be priced the same. The goal is what they call an absolute return, which is just a fancy way of saying you plan to make money no matter what the overall market does. It's a game of precision and scale, not speculation.
Okay, so to build this specific arbitrage machine, you need two very particular, very high-quality parts. These are the two sides of the basis trade, and you'll see they are totally connected, yet almost never perfectly in sync when it comes to price. On one side, you've got a U.S. Treasury bond. You can think of this as the cash asset. It's basically an IOU from the U.S. government, one of the safest investments on planet Earth. On the other side, you have a Treasury future. This is what's called a derivative. It's a contract to buy or sell that exact same Treasury bond, but at a specific price on a date in the future. And here is the absolute key that makes this whole thing possible. The bond's price is based on the reality of interest rates right now, while the future's price is based on expectations, a guess about where rates will be down the road.
So because of that one fundamental difference, today's facts versus tomorrow's feelings, plus a bunch of other complex market forces, the price of the actual bond and the price of the contract for that bond are almost never identical. There's always this tiny little gap between them. And on Wall Street, that price difference has a name. It's called the basis. And that tiny gap, well, that's the fuel for this entire machine.
Look, finding a tiny price gap is one thing, but turning fractions of a penny into billions of dollars? Yeah, that requires some serious firepower. You need a colossal power source, a way to fund these gigantic trades cheaply and efficiently. And that's where the financial system's hidden engine comes into play. And that engine is the repo market. The name is short for repurchase agreement. And you have to understand, this is the essential plumbing for the entire global financial system. It's a market for incredibly short-term loans. We're often talking just overnight, where big firms lend each other massive amounts of cash using super high-quality stuff like treasury bonds as collateral. It's what keeps the gears of finance turning. And here's how it works. It's actually pretty simple. Step 1, a hedge fund sells a treasury bond to a lender and gets cash instantly. Step 2, at the exact same time, it agrees to buy that bond back, usually the very next day. And step 3, the price to buy it back tomorrow is just a tiny bit higher than the price they sold it for today. That tiny difference, that is the interest on the loan. For the lender, it's an incredibly safe deal because they're physically holding that treasury bond the whole time.
Now, the scale of this it's almost impossible to wrap your head around. We are talking about an estimated $4 trillion moving through this market every single day. That is more than the annual GDP of a country like Germany being traded overnight, every single night. This is not some niche little market. It is the absolute bedrock of liquidity for the entire world.
Okay, so we have our components, the bond and the future. We have our power source, the repo market. Now, let's put this machine together and take a look at the insider's playbook for how this trade actually goes down.
First, the trader goes long cash. That just means they buy a U.S. Treasury bond. At the exact same instant, they go short the future, which means selling a Treasury futures contract that, because of the basis, is trading at a slightly higher price. Right there, they've locked in that price difference. Step 3 is the brilliant part. To pay for the bond, they immediately use that same bond as collateral in the repo market to borrow the cash. They're barely using their own money. Then they just wait. You see, it's a fundamental rule that as a futures contract gets closer to its expiration date, its price has to merge with the price of the real thing. The basis naturally shrinks to zero. And finally, right before it expires, they reverse everything, buy back the future, sell the bond, and walk away with that initial price gap as pure profit.
But wait, how can that tiny profit actually be worth anyone's time? Well, the answer is one of the most powerful and one of the most dangerous forces in finance: leverage. Leverage is just using borrowed money to make your bets way, way bigger. It's the ultimate double-edged sword, right? It magnifies your gains, but it also magnifies your losses. And in this trade, the repo market provides the fuel for almost unimaginable levels of leverage.
Just look at the math to see how staggering the impact is. Let's say the basis profit is just 0.05%. Super tiny. On a $100 million trade, that's 50 grand in profit. That's a pathetic 0.05% return. Nobody's getting rich off that. But with 100-to-1 leverage, the fund only has to put up $1 million of its own capital to control that same $100 million position. The profit is still $50,000, but now the return on their money is a very, very nice 5.0%. And that is how you turn pennies into billions.
So it sounds perfect, doesn't it? A predictable profit, funded with super cheap overnight loans, and then amplified into huge gains with massive leverage. It's a flawless machine built on pure logic. But every machine, no matter how well it's engineered, has a weak spot, a potential point of failure. And in this case, the hidden flaw, well, it's catastrophic.
So you have to be asking, right? If the prices are basically guaranteed to meet up in the end, if the profit is practically locked in from the very beginning, what could possibly go wrong? The strategy seems completely foolproof.
Well, here's the brutal truth. 99.9% of the time, the basis behaves exactly as it's supposed to, calmly shrinking towards zero. But in moments of extreme market stress, think a financial crisis, a global pandemic, all the rules just go out the window. Panicked investors start dumping anything that looks risky, like futures, and they all rush into the safety of treasury bonds. When that happens, the basis doesn't shrink. It suddenly and violently widens. And now, that risk-free trade is hemorrhaging millions of dollars per second.
And because the position is so incredibly leveraged, even a small widening of that basis creates enormous paper losses. That triggers the most feared thing in finance, a margin call. The broker calls and demands the fund deposit millions more in cash, and they need it right now. If the fund can't get the cash, and believe me, in a crisis, cash just vanishes. The broker doesn't wait. They start force-selling the fund's assets, which makes the problem worse, which triggers more selling. It's a death spiral that can turn a theoretical loss into a very real, catastrophic bankruptcy in a matter of hours.
And this isn't just some theory. This has happened. In 1998, a hedge fund called Long-Term Capital Management, famously run by literal Nobel Prize-winning economists, the smartest guys in the room, it blew up in the most spectacular fashion. And what was their main strategy? You guessed it, bond arbitrage, very much like the basis trade, using terrifying levels of leverage. When Russia defaulted on its debt, it sent a shockwave through the markets. Their safe trades went completely haywire, the margin calls came flooding in, and the fund collapsed so fast that the Federal Reserve had to orchestrate a massive bailout to stop it from taking the entire global financial system down with it.
This quote really says it all, doesn't it? The spread is small, the logic is sound, and yeah, most of the time, the gap closes just like it's supposed to. But the danger was never in the trade itself. It was in the immense, breathtaking leverage they used to make it worthwhile. It's a strategy that works perfectly, right up until the one moment it doesn't. And when that happens, it threatens to bring the whole system down with it.